All right, let's jump right into this explainer, where we're going to demystify the increasingly complex world of commercial equipment financing for Canadian contractors in 2026. Look, whether you're moving dirt in Ontario or supporting those massive mega projects up in the northern Alberta oil sands, securing the right machinery is literally the lifeblood of your operation. But as we're going to see today, acquiring that heavy iron has turned into a really high-stakes game of financial strategy.
This quote from John Deere just hits the nail on the head, doesn't it? It perfectly illustrates the stakes we're dealing with here. You're running a heavy-duty business, not a hedge fund. Securing your equipment is absolutely vital to your survival, but the reality is the way you choose to finance that equipment can either propel your business forward or just completely drain your operating cash.
I mean, think about it. When you're looking to acquire these incredibly massive, expensive physical machines, like the tractors and combines we're talking about, the financial math behind the acquisition can absolutely make or break your cash flow. We are talking about hundreds of thousands of dollars on the line. The decisions you make before you ever even step foot on a dealer's lot or, browse a private sale are going to echo through your balance sheet for the next 3 to 7 years.
So, here's our roadmap for today. 1. The 2026 financing landscape. 2. Buy, lease, or rent. 3. Decoding rates and lenders. 4. Reading the fine print. And 5. Strategic moves for 2026.
Okay, let's kick things off with Section 1, the 2026 financing landscape, navigating a tightening market.
So what's actually happening out there? Well, according to industry insights from Stride Capital, 2026 is seeing some serious market consolidation and way tighter credit. And what that means for you is lenders are pulling back. They're heavily scrutinizing applicants right now. We're seeing major shifts, things like National Bank purchasing CWB and its equipment division, or ATB selling its equipment finance division off entirely. Experts are actually comparing this wave of consolidation to the environment we saw right after the 2008 to 2010 financial crash. And because of all this uncertainty, businesses are just laser-focused on cash flow. They're utilizing strategies like sale and leasebacks to free up equity from the equipment they already own just to create a bit of working capital. Moving right along to Section 2. Buy, lease, or rent. Choosing your acquisition path.
John Deere's financing guide outlines this core dilemma perfectly. On one hand, a standard loan means you own the equipment and you get to depreciate the asset, which is great, but you're facing much higher upfront down payments and larger monthly payments. So it builds equity, sure, but it can really drain your cash. Now, a lease, on the other hand, protects your cash reserves. You get lower upfront advance payments and generally lower monthly costs. The trade-off? Well, you don't own it outright, you might not be able to depreciate it for taxes, and you're often subjected to pretty strict annual hour restrictions on how much you can even use the machine.
Now, if you do decide a lease is the better move for your cash flow, you've got to choose between two totally different structures. An operating lease, which is often called a fair market value lease, means you have absolutely no intent to own the thing. You're only paying for the depreciation during your specific usage. That gives you the lowest possible monthly payment, and you can generally deduct those payments for taxes. But then you have a finance lease, or a $1 buyout lease. This means you fully intend to purchase the machine at maturity. It acts a lot more like a loan, building up your equity. But you usually can't deduct those lease payments for taxes in the same way.
And then, of course, there's renting. Look, while renting completely avoids the risks of ownership, the maintenance headaches, and those long-term commitments, it generally carries the highest hourly or daily payments out there. It is strictly for short-term projects or really specialized tasks that fall outside your normal operations. It's absolutely not a viable financial strategy for your long-term, everyday operational needs.
Let's move to Section 3. Decoding rates and lenders, finding your tier.
Take a look at how this data from Iron Finance breaks everything down. It perfectly maps out how your credit score dictates exactly which bucket you fall into. The big 5 banks and those captive finance arms, like CAD or John Deere Financial, they offer the lowest rates, sitting between 6.5 and 8.5%. But here is the major catch. They demand pristine credit. We're talking 750 or higher, usually for brand new equipment. If you fall into the fair or challenge tiers, applying at a big bank is honestly a waste of a credit pull. They're just going to decline anything outside their strict little box. Instead, you've got to look at equipment finance companies or private lenders, where those rates can easily climb anywhere from 10 to 18%.
But remember, the interest rate is only half the story here. Lenders will often hide behind a really attractive stated rate while secretly burying you in the fine print. You've got to watch out for things like documentation or origination fees that can easily hit $1,500. If you're buying used iron, they might force you to pay a hefty appraisal fee, and definitely beware of prepayment penalties. Imagine you land a massive contract and want to pay off your equipment early. Some lenders will actually penalize you heavily just for doing that.
So here's the golden question you should always ask yourself when comparing lenders. Are you looking at the stated rate or the APR? The stated rate is literally just the interest percentage, but the APR, the annual percentage rate, that includes all those hidden fees we just talked about. An 8.5% stated rate with heavy origination and appraisal fees is actually way more expensive than a 9.25% APR with zero fees. Always ask lenders for the total of all payments over the life of the loan so you can get the true apples-to-apples cost.
All right, Section 4, reading the fine print, contracts and liability.
To really understand this liability, we have to look at the extremes. RNCIC Rentals highlights the severe operating realities up in Fort McMurray, right in the heart of the Canadian oil sands. Up there, turnaround maintenance on billion-dollar upgraders happens around the clock, in minus 40 degrees Celsius. In these brutal industrial environments, equipment, like those massive flameless heaters, has to be staged perfectly before turnaround windows even open. If your equipment fails or if it isn't procured in time, you are looking at catastrophic, cascading downtime costs that can completely cripple a contractor.
And when you lease specialized equipment for environments like that, the legal burden lands entirely on your shoulders. Just look at a standard Western Canadian spill services lease agreement. The strictness is intense. The term is heavily restricted, usually a maximum of 14 days, and during that time, you, the lessee, are completely legally liable for maintaining all risk property insurance. You have to supply all the fuel, perform highly complex environmental decontamination before you even return it, and ensure the asset remains totally free of any liens. You aren't just renting a machine here, you are assuming the total operational risk.
Which brings us to our final section, Section 5, Strategic Moves for 2026, the Action Plan. First off, let's talk about what you should actually be buying. A really massive strategic move right now is targeting what Iron Finance calls the used equipment sweet spot. We're talking about machines in the 3 to 7-year-old range. Why? Well, because the steepest, most painful initial depreciation hit has already passed. The machine is still well within its working life, and crucially, lenders still view it favorably. That means your interest rates remain highly competitive. Really, they're only slightly higher than if you were buying brand new.
Next up is your approval playbook. Stride Capital heavily advises that presenting meticulously organized financials from a proper certified CPA is going to dramatically speed up your approval process and secure you much better terms. Remember, lenders are tightening up. Messy books are going to result in a swift decline. Second, apply to the correct lender category first. If you're sitting at a 640 credit score, do not let a Big 5 bank do a hard pull on your credit just to reject you. Go straight to an equipment finance company instead. Also, make sure you budget for your province's sales tax. 5% GST in Alberta looks very, very different at signing than 13% HST in Ontario. And finally, I'll say it again, always ask for the equivalent APR.
Just let this number sink in for a second. 22%. That is the staggering top-end interest rate you could get hit with if you failed to prepare. If your credit is challenged, your books are a mess, and you find yourself trying to finance an old, high-hour machine through some private lender of last resort, this is the harsh reality of your cost of capital in 2026. Which brings us to our final critical question today. Are your books tightly organized to secure the heavy iron your business needs, or are hidden fees and a mismatched lender about to totally drain your cash flow? You have to evaluate your operational readiness, clean up those balance sheets, and really understand your credit tier before you ever step foot in a dealership. Because in the tightening market of 2026, preparation is the ultimate difference between getting by and getting ahead. Thanks so much for joining me on this explainer, and I will see you next time.